Hello, soldiers. Welcome to November 2022 Advanced Accounting RTP session. I know you all are almost at the end of your final revisions. To add one more value addition to the fraternity, that is to the student fraternity, here I am providing a quick analysis with respect to RTP November 2022 Advanced Accounting. As you know, guys, as I already mentioned, which is a clear-cut analysis part. Here we are not discussing anything related to computations, and don't expect the detailed classroom explanation because you are almost at the end of your preparations and you are almost ready for your examinations. Just you are testing your level of knowledge and the logics which they are in generally we are using to resolve such problems. Just I need to discuss here. Guys, before directly discussing things related to the problems, sir, is there any specific amendments which are applicable for November 2022 examination, sir? Sir, the common amendments related to Schedule 3, there are one amendment, fixed assets right now, they are clearly represented as PPE. Whenever you are presenting the balance sheet on behalf of fixed asset, you should need to represent PPE. That is one thing. And one more. So the recent amendment which was took place actually in 2021 actually. Which is related to current maturities of long-term borrowings. Current maturities of long-term borrowings. I mean, for example, if you issue debentures, the debenture redemption period will be the 5 years. Let us assume you are at the end of the 4th year. Now, at the time of presentation of financials at the end of the 4th year, the debentures are termed as current maturities of the long-term borrowings. Earlier, which were shown under other current liabilities, but as per the amendment takes place in the year 2021, which is showing under short-term borrowings. That specific amendment is applicable to group 1. I can call it as, because finance statements of company specific chapter will be available in group 1. But anyway, whenever it come across at the time of presentation of balance sheet during various chapters, you can just have an idea. That's why just I explained that point as well. Okay, just leave it. Apart from all such things, sir, related to specific chapters, is there any specific amendments, sir? There are no specific amendments except for the chapter ESOP, Employee Stock Option Plan. Don't worry, all the problems and the classroom discussion was entirely made based upon the new guidance note only. New guidance note. Okay, that's why I don't want to mention all such specific amendments, because the content which you already listened at the time of watching my video lectures were completely based on the new guidance note only. That guidance note was based on share-based payments guidance note, which was released in the year 2020, which was applicable 1st April 2021. Just I mentioned that point as well. Sir, India's applicability, coming to for a CA inter level, India's are not at all applicable. That point also just here they mentioned in now not applicable for November 2022 examination. And one more important fact, guys, related to banking companies. That is, he is talking about SLR holdings, statutory liquidity ratio. So as per the study material, the current SLR is 23%. The same percentage is also applicable for November 2022 examinations. The reason is they already given the SLRs for all the future years for June 30, 2023, 22, September 21, December 31st, 2023, 20, like that. Just they are decreasing 1% and finally they decreased to 0.5 percentage in future March 31st, 2024. But for our current examination, which is going to be held in the month of November 2022, so the applicable rate will be 23%. That one also they mentioned here 23% clearly. So please all of you follow the SLR statutory liquidity ratio for banking companies, which is 23%. Sir, except these 3 or 4 issues, there are no specific amendments which are applicable for the paper for advanced accounting. Okay, without wasting much time, let me directly entering into the problems. First, let us see problems related to accounting standards, guys. All of you, please come to the last Roman. Okay, you know how the RTP is going to design in generally. In RTP, they may try to cover each and every topic. For each and every topic, RTP contains one problem. But in examination, you know, it is not possible to cover all the topics and all the problems. But here, as an analysis part, we are trying to covering each and every topic which was exist in our study mat. So the first problem is from As4, contingencies. Contingencies and events occurring after the balance sheet date, which is theoretical question. What the question is all about? Explain accounting treatment of contingent gains as per As4, contingencies and events occurring after balance sheet date. I clearly told you after introduction of AS29, the entire content related to contingencies was shifted from AS4 to AS29 actually. But still AS4 discuss things related to contingent loss and contingent gain. Am I right? I clearly told you if the contingency is related to the contingency gain, contingency means there is no virtual certainty. There is no virtual certainty, because if it is virtually certain, then which is not treated as contingent gain, which is known as real gain. So if there is no virtual certainty which is contingent gain, then it should not be represented in the financial statements. If you have any doubt, I'll open my OneNote. I'll go to AS4. Just a moment. So this is our notes. AS4 you can open directly. Now you can cross check here. Contingent gain not recorded in the financials. I clearly told you at the time of discussing AS4 in the classroom. Okay, sir, what exactly the meaning of contingency? Contingency is a condition or situation, and the ultimate outcome may be the loss or gain. It will be known occurrence or non-occurrence of one or more future uncertain events. Here I defined the contingency. First, you can write the definition of contingency loss, or simply the definition of contingency. Then after that, simply you can provide the backbone. Sir, if the contingency is related to the contingency gain, which is not virtually certain, so as per the concept of prudence, if you recognize such a gain into the statement of P&L, then the current year profits may fetch higher. So which is against the prudence concept. So that's why contingency gain will not be recorded in the books of accounts. Let me cross check with the answer given in the RTP as well. What they are given. Accounting treatment for contingency gain. Please all of you observe here point number 12. Contingent gains are not recognized in the financial statements right away, since their recognition may result in the recognition of revenue which may never be realized, which is not a realized gain. However, when the realization of gain is virtually certain, then such gain is not a contingency, and that at that point of time, recognition of the gain is appropriate. Contingency, if there is no contingency, means which is virtually certain. If it is virtually certain, means you can recognize the same facts just they established here. Next, guys, come to As5. Net profit or loss for the period, prior period items, and changes in accounting policies. Sir, what this problem is all about? Bila Limited has a vacant land measuring 20,000 square meters, which it had no intention to use in the future. So the land, just they don't want to use it for their business purpose. That's why the company decided to sell the entire land to tide over its liquidity problems. The company was completely in liquidity crunch. The company was suffering from severe liquidity crunch. That is the reason why they want to sell the vacant land to the outside party. And through sale of such vacant land, they are earning a profit of 10 lakhs. Moreover, there was a fire in the factory, and a part of the unused factory shed valued at 8 lakhs was destroyed. The loss from the fire was set off against the profit from the sale of land, and the profit of 2 lakhs was disclosed in the net profit from sale of assets. Do we agree with the treatment and disclosure? If not, state your views. Simply, here actually two events are there. One is profit arised on sale of land. Profit arised on sale of land. Another event is loss arised due to fire accident. Loss arised due to fire accident. Profit arised due to sale of land. How much, guys? How much they given? Which was 12 lakhs. Sorry, 10 lakhs. Which was given at 10 lakhs, right? And the loss arised due to fire accident given at 8 lakhs. Just they want to set off the profit with loss and they want to show net profit through sale of land as 2 lakhs. Is this statement is correct? Just they are asking. One thing you need to know from AS5, if the activities are extraordinary activities, such extraordinary activities we should need to present distinct from ordinary activities clearly, right? We should not net off the entire effect of the extraordinary activities. You should need to clearly present. What exactly the meaning of extraordinary activities? Extraordinary activities are those activities which are clearly distinct from ordinary activities. If you check here, sir, loss arised due to fire accident is a clear-cut extraordinary activity, you know. Sir, is this profit arised on sale of land? Is it extraordinary activity, sir? In this case, it is extraordinary activity. In generally, sale of land is an ordinary but exceptional. But in this case, sale of land is an extraordinary. Do you know why? Sir, the reason for selling of such land is to recover from the severe liquidity crunch. That means the company is suffering from the liquidity crunch in generally, which never happened. So which are non-recurring events? Which are non-recurring events? So if the events effect is non-recurring, then we can completely treat them as, tell me guys, extraordinary activities. Sir, in case of extraordinary activities, they should need to represent clearly in the statement of P&L. They should not set off. That's why this profit we need to represent separately, and this loss also we should need to represent separately. We should not make it set off. So what the essence of this? We can cross check through RTP answer. Please check all of you. As5 net profit or loss for the period prior to items and change in accounting policies. Extraordinary items should be disclosed in the statement of profit and loss as part of P&L. The nature and the amount of each extraordinary item should separately disclosed. It should be separately disclosed from the ordinary in the statement of P&L. Separately means they should need to separate from ordinary and they should need to disclose the gross amount without making set off with the other extraordinary activities as well. So in the given case, the selling of land to tide over liquidation problems as well as fire in the factory does not constitute an ordinary activities of the company. These items are distinct from ordinary. Both the events are material in the nature and expected to recover and not expected to recur frequently or regularly. Thus, these are extraordinary items. Just this analysis is proving that these activities are extraordinary activities. Therefore, in the given case, disclosing net profits by setting off of each other is not correct. So the profit on sale of land and loss due to fire accident should be disclosed separately in the statement of P&L. Hope you got my point, guys. So you can come to the next problem, guys, which is As7 construction contracts. Sir, on 1st December 2020, Sampath Construction Limited undertook a contract to construct a building for 108 lakhs, which is a total contract revenue. Am I right, guys? On 31st March 2021, the company found that it had already spent 83.99 lakhs on the construction. This is contract cost incurred till the date. A prudent estimate of additional cost of completion was 36.01 lakh. You are required to compute the amount of provision for the foreseeable loss which must be made in the final accounts for the year ended 31st March 2021 based on As7 accounting for construction contract. First of all, you should need to know the provision. As per As7 construction contract, at any point of time, the total estimated contract cost exceeds the contract revenue. Then for the expected loss, you should need to create a provision irrespective of percentage of completion, whether work has commenced or not. Even though the company or the entity is getting profits from the other construction contracts, irrespective of all these three facts, we need to create a provision. Now, in the given case, if you check, the total estimated contract cost to complete the contract was 83.99 plus 36.01. How much, which is? The total is 120 lakhs, which is the estimated total contract cost, which is greater than the contract revenue 108 lakhs. That's why the excess of 12 lakhs, for the excess of 12 lakhs, you need to create a provision. As per these provisions, let me cross check the answer with the solution. So the total estimated contract cost 120 and the contract price 108, therefore foreseeable loss of 12 lakhs. As per AS7, when it is probable that total contract cost will exceed the total contract revenue, the expected loss should be recognized as an expense immediately, irrespective of, here provisions were not given completely. You can write the complete provisions as well. Irrespective of percentage of completion, irrespective of whether work has commenced or not, even though the entity is getting profits from the other construction contracts. Is it okay, guys? Come back. Come to the next problem, which is AS9 revenue recognition. When revenue will be recognized in the following situations? Total 4 situations given. You should need to understand the situation and you can provide the answer when in generally we can recognize the revenue. Where the purchaser makes a series of installment payments to the seller and the seller deliver the goods only when the final payment is received. Here is a seller, here is a buyer. Seller is just paying installment payments, but buyer is paying installment payments, but seller will deliver the goods after getting the final installment only. That means the real ownership of the goods will be transferred from seller to the buyer after getting the final installment. Am I right or wrong? So the logic behind the recognition of the revenue at the time of sale of goods is all risks and rewards incidental to ownership should need to transfer from seller to the buyer, and there is no uncertainty regarding the collection of amount, then you can go for the recognition of the revenue. Now, in the given case, when the real risks and rewards incidental to ownership are transferred from seller to the buyer, when seller receives the final installment, till the date, seller can treat the entire installment amounts as advances only. Do you agree? So that's why in the given case, when revenue can be recognized after getting final installment amount only. Next, come to the second scenario where seller concurrently agrees to repurchase the same goods at a later date. We already discussed the same issue in the classroom. Sir, how it is happening? X and Y, two parties are there. X sold goods to Y for 1 lakh. After 6 months, Y sold the same goods to X for 1.2 lakh. Now, this is a pure finance agreement. The revenue is not related to the gross cash inflows. The revenue is really the interest income, which is also to the primary party. The interest is generally recognized on the time proportion basis, but the gross cash flows we never recognized as a revenue. This case we already seen directly in the classroom, and this is important case as well. Number of times are already tested in the exams. Coming to case number 3, where goods are sold to distributors, dealers, or others for resale. First of all, if these distributors or dealers are acting as an agents, it will be treated as a consignment. If these are agents of the main owner, then these distributors or dealers are consignors. I am telling the two situations, guys. If those are agents, if those are not agents, concentrate. If those are agents of the main owner, then the agreement will look like it as a consignment agreement. Am I right? In case of consignment, when the consignor really recognize the revenue, when the consignee sold goods to the outside parties. That means when the distributors and dealers and others resale to the customers, then only the main owner can recognize the revenue. That is the one scenario. In another scenario, if these distributors, dealers, or others are not the agents, then when risks and rewards incidental to ownership are transferred from main owner to the distributor or the dealers, then the main owner can recognize the revenue. In both the cases, you can provide the explanation because there is ambiguity is there from the given information. Is it okay, guys? Next, come to the point number 4. Commission on service rendered as agent on insurance business. We already discussed insurance agency commission when the insurance agent can able to recognize as a revenue as on the date of commencement of that policy or date of renewal. Why? Sir, if the policy holder pay the policy to the insurance company, then only agent will get commission from such insurance company. If the policy holder defaulted in making payments to the insurance company, then insurance company may not allow to provide the commission to such insurance agent. That is the reason why at least the renewal, that when the insurance company really renewed that policy, if the policy holder paid the amount, then the insurance company will issue the bills, that is the renewal bills. Am I right? That's why as on date of commencement or the date of renewal only, the commission can be recognized by the insurance agents. If you want, you can cross check the same answers with the RTP as well. So that is in the first case, when they can be recognized the revenue, when the final payment is received, then only they can recognize the revenue. In the second case, which is a pure finance agreement, that's why gross cash inflow should not be recognized as a revenue. In the third case, if the distributors or the dealers can generally be recognized if those are not acting as an agents, if all the significant risks are transferred. No. If they are acting as an agents, then which is treated as a consignment sale. In both the cases, I told you, this is one scenario, this is another scenario. Both the scenarios I explained. So related to insurance agency commission on the effective date of commencement or the renewal date of the policies, in generally they can recognize. Am I right, guys? All are exactly correctly discussed. Come back to As17 segment reporting. A company has an inter-segment transfer pricing policy of charging at cost less 10%. The market prices are generally 25% above cost. Is the policy adopted by the company is correct? Direct question from As17. Same question we discussed. Same as it is question. So the inter-segment transfer pricing policy is their own company decision. So if they want, they can transfer one segment to another segment at a cost price, at a cost, or greater than cost, or less than cost as well. Inter-segment transfer pricing policy is at the discretionary criteria of the management. If they want to transfer the goods from one segment to another segment at cost, they can. At greater than cost, they can. At less than cost, they can. But whatever the policy they are following, that policy should be followed consistently, and the policy which they followed should be clearly disclosed under the notes to accounts as well. That's why even though in the outside market the prices are greater than 25% above the cost, even though as per the discretion criteria they can fix the inter-segment transfer pricing policy at cost less than 10%. It is possible. Let me cross verify the answer. So the inter-transfer pricing policy may be on cost or the below cost or at the market price. But whatever the policy they followed, the same should be disclosed and applied consistently. Therefore, in the given case, inter-segment transfer pricing policy adopted by the company is correct if it is followed consistently. Do you agree, guys? Sir, I'm not spending much time on problem by problem because these problems are direct problems which we were already discussed in the classroom. Guys, if you already not covered such things in your preparation, you may not be in a position to answer. As I already mentioned at the inception of this lecture itself, so we are almost at the edge of our preparation. Just we are cross-verifying our level of knowledge. Okay. Come to question number 16, which related to As18 related party transactions. SP Hotels Limited enters into an agreement with Mr. A for running its hotel for a fixed return payable to the latter every year. Sir, here SP Hotels is there. Here Mr. A is there. Just Mr. A enter into agreement with SP Hotels. What is such agreement? To running this SP Hotels business. As a result, Mr. A will pay certain fixed remuneration. Mr. A will enjoy the profits and Mr. A will pay fixed remuneration to the SP Hotels. Yes, these are in generally happening in current situation and the current scenario as well. Okay, because the hotel owner is one person and the hotel who are in generally managing are the different persons also. So the contract involves the day-to-day management of the hotel, while all financial and operating policy decisions are taken by the board of directors of the company. Sir, Mr. A, just he will manage day-to-day management activities, but all the financial and operating policy decisions. Financials and operating policy decisions means, sir, how much remuneration should need to be fixed to the persons? How much loan we can avail from the banking companies? Operating policy decisions means how the operation should need to be done. So what are the protocols they need to follow? All such things are completely, all such decisions are completely taken by board of directors only. Mr. A does not own any voting power in the SP Hotels Limited as well. In SP Hotels, private limited company, Mr. A doesn't have any voting power. Would he be considered as a related party of SP Hotels Limited? Straight away, my answer is no. Do you know the reason? As per AS 18, who are all called as related parties, guys? There should be holding and subsidiary relationship, at least. That is, there should be controlling interest. There should be controlling interest. Is there any controlling interest? There is no voting power at all. At least, is there any significant influence? Significant influence means at least he should hold with 20%, or he is form part of the board of directors team. So both are not satisfied. That's why there is no significant influence as well also. So merely having control on the day-to-day management, we can't tell Mr. A as a related party to SP Hotels. If he has the substantial interest in the SP Hotel, or at least he will have the significant influence in the SP Hotels board of directors team, there is a control on the composition of the board of directors at least, then Mr. A, we can tell it is a related party. But in the given scenario, he have a right to manage the day-to-day activities. That's why he is not a related party of SP Hotels. So let me cross check the answer with the answer given in RTP. Individuals owning directly or indirectly an interest in the voting power of the reporting enterprise that gives them either control or the significant influence over the enterprise. And such party is known as a related party. But in the given case, in the absence of share ownership, Mr. A would not be considered to exercise significant influence or the control. Even though there is an agreement giving him power to manage the company on the day-to-day activities, he is not treated as a related party, because even though he does not have an ability to direct or instruct the board of directors as well, that means there is no control on the composition of the board of directors, and there is no control with respect to voting power. There is no significant influence with respect to voting power as well. That's why he is straight away out of the box from the related party definition. Is it okay, guys? Come down, come to problem number 17, AS19 leases. So what this problem is all about? Win Limited has entered into 3-year lease agreement with Tanya Sports Club. So Win Limited is lessee, Tanya Sports Club is lessor. In respect of fitness equipments costing 16,99,999. Simply you can call it as 17 lakhs. The annual lease payments to be made at the end of the each year are structured in such a way that the sum of the present values of the lease payments and that of the residual value together equal to the cost of the leased out. What he is telling, cost of the asset equal to present value of the lease payments plus present value of the residual value. Yes, that is absolutely. If that is the case, then in generally such lease is known as finance lease, guys. So the present value of the future lease rentals, if it is approximately equal to the fair value of the asset, then which is known as finance lease. Okay, indirectly he is telling that the lease is a finance lease. The unguaranteed residual value of the equipment at the expiry of the lease is estimated to be 1,33,500. The assets would revert to the lessor at the end of the lease. Okay. Given that the implicit rate of interest is 10%, you are required to compute the amount of the annual lease payment and the unearned finance income. Discounting factor at 10% for years 1, 2, 3 are given. Sir, here I am asking you one thing, guys. You know the residual value 1,33,500. So this is at the end of the third year. Now to know the present value of the residual value, you can multiply with 1,33,500 into 0.75, which is the present value of residual value. But you don't know the present value of the lease payments. You know the cost of the asset. If you reduce the cost of the asset, 17 lakhs, minus this 1,33,500 into 0.75, then you will get the present value of the total lease payments. Then to get the annual lease payments, if it is divided with the present value annuity factor, you will get the annual lease payments, because this is the present value of all the lease rentals. One more time I'm repeating, just I'll put the same equation in my OneNote for better understanding. Just a second. Yeah. So please concentrate. We know one thing. What is that? As per AS19, or as per the given question information itself, cost of the asset is equal to present value of lease rentals plus present value of residual value. You know the cost of the asset, right? Which was 16,99,099.50. You don't know the total present value of the lease rentals, but you know the present value of the residual value. Residual value given at 1,33,500, which is at the end of the third year. That's why into 0.75 for third year factor. Now to know the annual lease rental, first 16,99,099.50 minus 1,33,500 into 0.751. I'm not making any computations here, guys. Divided by present value annuity factor. Why I am using the annuity factor? Don't take the 1 year factor. It is a combination of all factors. If you multiply, or you can simply present value annuity factor into lease rental. That's why divided by present value annuity factor. Because the annual lease payments to be made at the end of the each year are structured in such a way that the sum of the present value of all the lease payments, sum of the present value of all the lease payments means present value annuity factor into lease rental only. Now here present value annuity factor is 123 total. If you can add it, that is 0.909 plus 0.826 plus 0.751. If you add it, which is 2.486, this value is 2.486, then you will get annual lease rentals. Out of the two questions, first question is over, annual lease payments. Unearned finance income. Sir, unearned finance income is the difference between gross investment in the lease and the net investment in the lease. You know the net investment in the lease already. Net investment in the lease is nothing but present value of lease rentals and present value of the residual value, which is cost of the asset, which is 16,99,999. Sir, then what is the gross investment in the lease, guys? If you know the annual lease payment, the annual lease payment plus residual value without applying the present value is the gross investment in the lease. In the first question, you know the annual lease payment, huh? From such annual lease payments, just add all the annual lease payments or multiply with simply 3, then you'll get the total annual lease rentals plus residual value here itself is there, which is 1,33,500. Then you will get the gross investment in the lease. Then the difference itself is the unearned finance income. So let me cross check the answers here. So the same, just they applied. First, this is the cost of equipment. This is the residual value. If you observe here, my answer with the RTP answer, just they reduced this factor, then they got the fair value of the asset. Just they reduced, then they got the fair value of the asset. With that, they divided the present value annuity factor, which was 2.486. Then they got the annual lease payment of 6,43,500. Now gross investment in the lease is 6,43,500 into 3, which is 19,30,500 is the gross investment in the lease. Am I right? Plus UCRV as well. I need to add the unguaranteed residual value, which is also 1,33,500 straight away given in the problem. Then which is gross investment in the lease. It was reduced from net investment in the lease, which was 16,99,999, which is the unearned finance income. Guys, all type of problems we already done in the classroom. Again, I am mentioning just as a part of analysis, just the logics here I am putting once again. Go back, guys. Come to AS20. What the problem is all about. The following information relates to XYZ Limited for the year ended 31st March 2022. Net profit for the year after tax given. This you can call it as PAT. Number of equity shares 5 lakhs. If they asked only the basic, you can calculate here itself 37 lakh 50,000 divided by 5 lakh, which is 7.5, which is the basic EPS. Next, convertible debentures issued by the company at the beginning of the year. 8% is convertible debentures of rupees 100 each, which were 50,000. Equity shares to be issued on conversion 55,000. Now, in calculation of diluted earning per share, you need to consider the potential equity shares. What is the meaning of potential equity shares? Potential equity shares are those equity shares which have the capability to increase in the earnings without increase of resources. Now, convertible debentures are one type of potential equity shares. In future, if these convertible debentures are going to convert into equity share, how much increase in the earnings really? Now, to the extent of interest was completely saving, which you can treat it as earnings only. No need to pay the interest. So that's why for this 37 lakh 50,000, you can add interest after tax, guys, which is interest into 1 minus tax rate. Interest how much, guys? 50,000 into 100 is the interest, and the tax rate was given at 30% into 70%, which was 3 lakh 50,000. Am I right? 50,000 into 100 into 8% is the interest. I'm so sorry. So 4 lakhs is the interest into 70% is 2,80,000 is the savings in interest after tax. This is the adjusted profit after tax for calculation of diluted EPS. 37 lakh 50,000 plus 2,80,000, which is 40 lakh 30,000. So this is adjusted PAT. Fine. Now, you should also calculate WANES, weighted average number of equity shares. Earlier, which are 5 lakhs, due to conversion of these debentures, number of equity shares you will get 55,000. So total 5 lakh 55,000. So divided by 5 lakh 55,000, then you will get diluted EPS 40 lakh 30,000 divided by 5 lakh 55,000, which leads to 7.26. Guys, from 7.5 to 7.26, is there decrease or not? Yes, decrease is there. That's why this 7.26 you can call it as dilutive EPS. So the same thing you can cross check here as well, guys. So basic EPS 7.5, diluted EPS is 7.26 per share. Sir, convertible debentures, or you can treat it as a potential equity shares. For that explanation was given under note. That's it, guys. This type of problem we already done. AS22, theoretical questions just they asked. Define the following as per AS22. Accounting income or accounting loss. Sir, accounting income or loss is the profit after tax as per the financial records under statement of P&L. As per statement of profit and loss account, after taxes, how much profits or loss just they represented such profits or loss, you can call it as accounting income. Taxable income is nothing but the income which is going to be calculated as per the Income Tax Act 1961, which is nothing but the taxable income. Tax expense or the tax saving. Tax expense or the tax saving is the combination of current tax and deferred tax, which is the combination of current tax and deferred tax is known as tax expense. So let me cross verify the answers here. Accounting income is the shown under statement of P&L. Taxable income is determined as per the loss of the income tax. Tax expense is the combination of current tax and deferred tax. Is it over? Guys, once you are fulfilled with your conceptual knowledge, then you can create miracles in the examinations, guys. So the only thing you should need to acquire is conceptual clarity at the time of listening the classes and at the time of revising the things. Then you can play the games as your wish. Okay, guys, come down. AS24 discontinuing operations. What are the disclosure requirements in interim financial reports as per AS24 for discontinuing operations? Guys, this question no need to check. I also not discussed, and I am also telling that no need to check for examination. The reason was interim financial reporting is related to AS25. Without knowing the knowledge of AS25, how you can get the expert knowledge in disclosure requirements with respect to AS24? You may raise a question, but sir, AS24 will be there in our syllabus. I do agree, but without knowing the knowledge of AS25, you cannot, or you are unable to provide the answers for this question. So that's why you can simply ignore, and they never asked in the previously, they never asked in the past, and they will not ask in the future as well. No worries, just leave it. Come to AS26 question. Two more questions are there from the standards. Then we can enter into the main topics. AS26 intangible assets. The question is from intangible assets. K Limited launched a project for producing the product X in October 2021. Company incurred 40 lakhs towards the research and development expenses up to 31st March 2022. Due to prevailing market conditions, the management came to conclusion that the product cannot be manufactured and sold in the market for the next 10 years. The management hence wants to defer the expenditure write-off to future years. Advise the company as per the applicable accounting standard. We know only one thing. As per AS26, the entire research phase expenses straight away transferred to P&L. The reason is no product was established at that point of time. If there is no product, no future economic benefits, straight away you can charge it to P&L. Sir, what about development phase expenses? In the development phase expenses, if the product is successful, then you can capitalize. If the product is unsuccessful, again, you can charge it to profit and loss account. Sir, the base provisions of AS26, or you can take the base provisions of AS10. Both are same, related to recognition of the asset. When an intangible asset or when an PPE can be recognized into books of accounts, it have the capability to generate the future economic benefits. In the given scenario, the product cannot be manufactured and sold in the market for the next 10 years means by using the asset, we cannot generate any future economic benefits in the future. If there are no future economic benefits, then you are not eligible to recognize the such intangible asset into your books of accounts. So the conclusion was, you should not defer. The entire amount should be charged to P&L account in that year itself. The entire expense of 40 lakhs should be charged to P&L account in the year itself. You should not defer. Deferral concept is not at all exist as per any existing standard. Now you can cross verify the answer. What is that? Sir, intangible asset expenditure on research should be recognized as an expense straight away. I told you the first point. An intangible asset arising from development should be recognized if and only if the enterprise can demonstrate all of the conditions specified in the standard. I mean, if it is successful, it have the capability to generate the future economic benefits, and if it satisfy all such conditions, then they can recognize. An intangible asset should be derecognized when no future economic benefits are expected from its use according to the standard. No future economic benefits. Thus, the manager cannot defer the entire expenses of 40 lakhs should be written off in the current year 31st March 2022 itself. Is it okay, guys? Come back, which is the last question from our accounting standards, guys. Concentrate, all of you. Guys, question from AS29. Provisions, contingent liabilities, and contingent assets. Chavos Limited is in the process of finalizing its accounts for the year ended 31st March 2022. It seeks your advice in the following cases. So two cases are given. Chavos Limited has filed a court case in 1415 against its competitors. It is evident to its lawyers that Chavos Limited may lose the case and would have to pay 3 lakhs being the cost of litigation. No entries or provisions has been made in the books. First of all, what the question is all about? Kindly give your answers for each of the above with proper reasoning according to the relevant accounting standard. Also state the principles for recognition of provision as per AS29. Now, whether we can create a provision or not is the discussion in this problem. First of all, before checking all such things, what is the definition of provision, guys? All of you, you should need to provide the definition of provision. Then only you can able to answer these questions. Without providing the definition, just if you can tell whether creation of provision should be necessary or not, then they will not be awarded any marks. Then you will not be awarded any marks. Sorry. Sir, provision is a present obligation. which is a present obligation as a result of the past events. As a result of the past events. And there is a outflow of resources embodying economic benefits. Outflow of resources embodying economic benefits. And which should be reliably estimated. If these three conditions are satisfied, then you can create a provision. Now, my question is, sir, in the first scenario, is there any present obligation, sir? Yes, there is a present obligation because as per the evident of the lawyer's advice, it is clearly given that the cost of litigation, we should need to incur the damage of 3 lakhs, which is a present obligation. There is no other alternative to escape that obligation, then such obligation is known as present obligation. Sir, is there any outflow of resources? Yes, 3 lakhs we need to pay in the court of law. That's why there is outflow of resources. Sir, is there any reliable estimate? Yes, as per the evidence or the advice given by the lawyer itself is that you can take it as an estimate. That's why we can create a provision in this case. Coming to the second scenario, a new regulation has been passed in 2022 by the Healthcare Ministry to upgrade the facilities. So for all the hospitals, they should need to upgrade certain facilities for the patients as per the new healthcare policy. Deadline set by the government is 31st March 2023. So deadlines, they need to complete the all such upgrade facilities by 31st March 2023. The company estimates an expenditure for 10 lakhs for the said purpose. Okay. Kindly give your answer for each of the above. Now my question is, we are in the financial year 21-22. For this year 21-22, is there any present obligation? Sir, I will not upgrade the facilities by the year end 2022. What will happen? Nothing will happen. But if you are not upgrading the facilities at the end of 2023, then there may be a chances of recovering the penalties by the government. That's why we are in the financial year 21-22. Even though if we are not upgrading the facilities, we can escape from upgrading the facilities as of date. That's why there is no present obligation as of date. For the year 21-22, no need to create any provision. No need to create any provision because no present obligation. But if the same question, if they might ask it in the year 22, for the year 22-23, then your answer might be different. We need to create a provision. So if you want, you can cross check the answers with RTP, guys. So first they provided the definitions of AS29 here. Then the first scenario, there is a present obligation. That's why provision should be recognized. And the second scenario, there is no present obligation for the year ended 31st March 2022 because there is no obligating event either for the cost of upgrading of facilities or for the fines under the regulations. Hence, no provision should be recognized on 31st March 2022. Am I right? Fine. That's it, guys. This is all about accounting standards. I hope I made a good discussion on the accounting standards. Next, we can open the main problems. Yeah. So first, sir, in this video lecture, I'll try to complete up to the partnership firm problems. For the remaining problems, we can take another video lecture. That's a good idea. Yeah, please all of you come to problem number 1, guys, which related to dissolution of partnership. The question is related to highest relative capital method. Higher relative capital method. You know, sir, there are no disputes arised at the time of distribution of cash under the dissolution of a partnership firm when it is distributing among other parties other than partners. But at the time of distribution cash among the partners, there may be a chances of arising the disputes. So to resolve such disputes, two methods actually we learned. One is higher relative capital method, another one is maximum loss method. Am I right? Sir, in case of higher relative capital method, how we need to work out? Outstanding capitals we will start, then profit sharing ratio, then outstanding capital divided by profit sharing ratio, then you will get a capital base per share, capital base per share, then capital base per share, lowest capital base per share into profit sharing ratio, then you will get, tell me guys, relative capital. If you compare the relative capital with the outstanding capital, then you will get a excess capital. This process we should need to continue till the end. One partner will end up the balance. Now, the partner who will end up with the balance is the first party, and the relative capital 2 is the next party, and the relative capital 1 is the next parties. Then we should also need to provide the summary of cash payments. So these two we will provide under working notes. Then under the main notes, simply we will distribute cash among all the partners, all the parties, including partners. That is the procedure in generally we followed, right? Now let us have a look into the problem. So before resolving the problem, that much of stuff should be there in your back of mind. The partners PQR have called you to assist them in winding up the affairs of their partnership as on 31st December 2020. Their balance sheet as on the date as given below. Land and building, plant and machinery, furniture and fixture, stock, debtors, cash at bank, loan P, loan Q. If you observe, partners, one second, sorry. If you observe, partners loan is there under asset side. If partners loan is there under asset side means partnership firm given loan to the partners. Partnership firm given loans to the partners. Now, at the time of working this outstanding capitals, these partners loan should be reduced from the partners capitals. That point also I clearly mentioned in the classroom. The reason or the logic is pretty much simple. Sir, these loans are given by firm to the partners, right? Now firm will think in this manner. At the time of dissolution of partnership firm, at the end, firm should need to settle certain amounts of partners capital, that is outstanding balances under partners capital. Then they should recover such amounts. The loans given to the partners, they will cut off, and the remaining balance just they simply distribute to the partners. That's why these loans should be knock off from the partners capital. In the remaining partners capital only you can shown here as an outstanding capital at the time of working the summary of cash payments and the working note as well. Okay, fine. And then come to equity and liabilities. Capital PQR was given. Creditors also information is there. Profit sharing ratio 4:3:2. Cash is distributed to the partners at the end of each month. A summary of liquidation transactions are as follows. Jan 2021. If you check the opening cash balance, 9,000 is there, which is the opening, and 9,000 they collected in Jan, plus 8,000 also they received from the furniture, and liquidation expenses incurred means minus 1,000. So now I have, apart from this 9,000, I have 16,000, but 6,000 cash retained for the next month. That means 6,000 we cannot utilize for distribution among the partners. That means if you add these three components, if you add these two components and if you minus it, I got 16,000. Out of 16,000, I cannot use the 6,000. That means for January, I can only utilize this 10,000 and the opening balance of 9,000 only. Then come to Feb 2021, opening balance 6,000 is there. Opening 6,000 is there because last year 6,000 cash retained na? And liquidation expenses straight away paid 1,000. Now I have 5,000 cash. A part payment of his capital or accepted a machinery for 9,000. Sir, why suddenly you bring R into the picture? We are following the payments, or we are following the working note for the purpose of distribution of cash among the partners. Why suddenly R is getting the machinery? That is deviation from the working note. Sometimes such points are also given in the questions. Such problems also we seen, and the same problem here they tested from the RTP. Whenever there is a deviation from the working note, now as per the given information in the problem, just we distributed. Again we will made the reworkings. Now after settling to the R, again we will check the outstanding capitals, again we will check the profit sharing ratios, then capital base per share, then relative capitals, then excess capitals. Like that we will check. Am I right? Okay, this is anyway one scenario was given. How to handle this scenario I will explain as well, no worries. Okay, sir, apart from this transaction, just put aside this transaction. Opening I have 6,000, liquidation expenses incurred 1,000, cash retained in the business at the end of the month 2,000. Then how much cash is available, you know? Minus 2,000 should be utilized for the next month means the utilizable cash for a distribution among the partners or the other parties was only 3,000. Okay, fine. Next, come to March 2021. Opening will be 2,000 is there. Don't ignore that. Opening 2,000 is there. 38 plus 10, 48. 48 minus 1,700. 48,000 minus 1,700 plus 41,000. 87,300. Apart from this 2,000, 87,300 cash I can utilize for distribution among the parties. Now, you are required to prepare a schedule of cash payment among the partners under highest relative capital method. First, all of you can go with a working note, guys. Let me explain with RTP itself. Just a moment, please. Yeah, guys. Yeah, guys. Please, all of you check here. Existing outstanding capitals. First, we'll start. All of you be with me. The problem is lengthy. Yeah. Sir, outstanding capitals P 65,000 minus 13,000. That is 52,000. For B, 50,500 minus 7,000. That is 43,500. For R, straight away you can consider 16,000, which was how much here? Sorry, 32,000 for R. That is 32,000. This is outstanding capitals. Then next, this is step A. Step B, profit sharing ratio. Then you will get capital base per share A by B. So lowest capital base per share multiplied with profit sharing ratio, then you will get relative capitals, which are relative capitals. Now outstanding capitals minus relative capitals, then you will get excess capitals. This process should need to be continued till the end of the partner. One partner will get the balance. So the same process repeated. That's why partner R get the first. Now in the series of payment, first time we should need to make payment to R. Second time, which is relative capital 2, second time we should need to make payment to Q and R for 4,500 and 3,000. And third time we should need to make payment to PQR, that is 52, 13 and 26. This is third time. This is the series of payments. Am I right? Now go to the main notes, guys. First, sir, balances after the loan, capitals like this and existing apart from the partners, creditors are also there. Only creditors 16,000. Now opening cash balance, we have 9,000, right? That 9,000 is there, which is opening cash balance. And we already decided at the end of Jan 2021, we can only have 10,000 cash for utilization. Such 10,000 I added. Now total I have 19,000. Out of 19,000, 16,000 you can make payment to creditors. Still I have 3,000 balance. Now as per the working note, to whom I should need to make first payment? For R. You can straight away make payment to R then. Then for R we distributed 3,000. After at the end of Jan 31st, these are the outstanding balances. There are no other liabilities, only PQR is there. Now in the month of February, what happened, you know? In the month of February, apart from this transaction put aside, we have 3,000 cash balance to utilize. We have 3,000 cash balance to utilize. Am I right? If this transaction not would be there, then this 3,000 we need to distribute. This 3,000 we need to distribute to Q and R in this ratio. In this ratio means that is profit sharing ratio. What is the profit sharing ratio? 3:2. The 3,000 rupees we should need to distribute among Q and R in 3:2 ratio actually. But what transaction occurred? The transaction occurred was, that is, which you can call it as what is that? Different transaction. I mean, we are not following the order of series of cash payments. Just against that, they are providing one transaction. As a part payment of his capital, or accepted a machinery for 9,000, or is getting 9,000 worth of machinery. That's why straight away you can provide 9,000 worth of machinery to R. First, 9,000 worth of machinery to R you can provide. Just a moment, guys. Where it is? In February, 9,000 machinery you can provide to R. Sir, actually then we need to distribute in the ratio, but 9,000 we provided to R, right? But anyway, in the second chance, the 3,000 cash balance is there na. Such 3,000 cash balance is there. We need to provide to whom? Q only. Because if 3,000 balance is there, we would distribute among Q and R in what is that ratio? In 3:2 ratio. But against this, R was already got 9,000 worth of machinery. That's why still we are not following this ratio. So the remaining amount of entire 3,000 cash balance we may distribute to Q only. That's why here simply they distributed 9,000 to R. Just a second. Simply they distributed 9,000 to R and the balance of cash 3,000 entirely to Q. Do you agree, all of you? But this is against to the series of cash payments we already decided in the working note. So these are the outstanding balances after making payment. Now, whenever there is a deviation from our working note, again, you should need to provide another working note by taking outstanding balances as these figures. That's why the second working note we started. These are the outstanding balances. Same procedure, profit sharing ratio, capital base per share, lowest capital base per share into profit sharing ratio, which are the relative capitals. Then you can compare relative capitals with outstanding capitals. You will get the excess capitals. Now again repeated the process. If they repeated the process, this is the end. This is the first series of payments. This is the second series of payments. This is the third series of payments. Now all of you please concentrate. Now 1,500 we should need to pay first whom? Q, right? Now please concentrate, all of you. At the end of March 2021, the scenario was we have the opening cash balance of 2,000, which was carried forward from the last month. Apart from that, we also have 87,300 balance as well. Now, out of this, first you should need make payment to whom? Partner Q. That's why first they made partner to 1,500 Q. It was not mentioned here clearly. It was mentioned here itself. Actually, this distribution entirely you should need to shown in the main statement, but they just shown in the working note. Just leave it. Just you can also assume it as a main statement. So partner C will get first 1,500. Is it okay? Fine. Next, sir. After that, 12,900 you should distribute to whom? P and Q. Just distribute to P and Q. Next distribution, PQR, you should need to distribute 40,000, 30,000, 20,000. But you are not having that much of balance because please all of you concentrate. How much balance you have? 87,300 plus 2,000. That is the cash balance you have as on 1st March 2021. Out of that, you paid 1,500. You also paid 12,000 and 9,000. So I have only 66,800 balance, guys. That 66,800 balance you can distribute among the PQR in the ratio of 4:3:2 with the available balance. Just you distributed like that. So that's why you added total payments 12 plus 26,689 for P. For Q, 1,500 plus 9,000 plus 22,267. For R, only 14,844. So these are the final payments you made to PQR. The same payments just they mentioned in the main statements here. So this is the loss they are getting while compared with their outstanding capitals. This is the problem under highest relative capital method. So the problem is pretty much simple. The only one special point you need to observe here is whenever we are deviate from the series of cash payments we already work out in the working note, just as per the given information in the problem, just first you can distribute. Then after such distribution, find out the outstanding capitals. Again, find the series of cash payments we need to follow. The order of cash payments we need to follow under the working note. Then simply follow that order. Then you can easily complete the problem. That's it, guys. Nothing more much discussion about this problem. Next, come to the LLP, guys. Can a partner be called upon to pay the liability of a LLP? If yes, under what circumstances? Guys, this question was not discussed by me in the classroom exactly, but if you apply your knowledge, what we learned in LLP, you can simply provide the answer. Sir, the title LLP itself gives privilege to the partners that their liability will be extended to the extent of their capitals holding. That's why, can a partner be called upon to pay the liability of LLP? The answer is no. That is the defect in the partnership firm. That is the reason why LLP Act 2008 came into existence, right? So that's why if the partnership firm if have their own liabilities, then the other party can have a right to ask that amount from the partner's personal assets. No, that is not possible. Am I right? If yes, under what circumstances? But in certain circumstances, the other party can ask partnership liabilities from that partner. Do you know in which circumstances? If that partner made certain frauds, or if that partner involved in certain what is that misrepresentations with the public, due to such acts, if partnership firm end up with the liabilities, then for such liabilities that partners may be responsible. Do you understand what I am talking here? In generally, partner will not be responsible for partnership liabilities in case of LLPs. But if the partner liabilities were established due to the fact that the partner conducted certain frauds or misrepresentations with the public, due to such fact the partnership firm incurred such liabilities, then such partner will be responsible. The same facts here are also mentioned in the RTP answer. You can cross verify, guys. Sir, in generally, partners of an LLP in the normal course of business are not liable for the debts of the LLP. But a partner shall be liable for his own wrongful acts or commissions, but shall not be liable for the wrongful acts or commissions for the other partners of the LLP. So that's why the partner who conducted the wrongful acts, like fraud or the willful omissions or the misrepresentations with the public, that partner is only responsible for that liabilities. The other partners are not at all liable. That is the common sense answer, guys, you can provide. Okay, fine. And the final problem which is related to the partnership firm as well as this lecture, and the remaining problems we can discuss in the other video lecture. Concentrate. So which is related to conversion of a partnership firm into LLP. Sorry, conversion of partnership firm into a company. You know, sir, all these type of problems, you can look into a amalgamation type of problems because they are in generally asking the accounting treatment in the existing company. Here, partnership firm is a selling entity. This company is a purchasing company. Now, what is the accounting treatment in the books of selling entity? The 5-step approach you followed in case of amalgamation, the same procedure you need to follow here as well. So first, let me read the question entirely. Then according to the question, we will provide the answer. A and B sharing profits and losses equally, 1:1, decide to convert their business into a limited company on 31st December 2021 when their balance sheet stood as follows. Debtors given, bills receivable, stock in trade, patents, plant and machinery, land and building. Debtors, loan creditors, bank OD. Reserve fund means general reserve. Capital funds, AB. Capital funds means partners' capitals. The goodwill of the firm was to be valued at 2 years purchase of the profits of average of the previous 3 years. Sir, some internally generated goodwill is there. First, we need to calculate the goodwill. For calculation of such goodwill, point number E information was given. The past working results of the firm showed that they had made a profits of 12,000, 1.2 lakh, 1,44,000 and 1,68,000 in 2021 after setting aside 8,000 to reserve fund each year. So that means what are the future maintainable profits? Future maintainable profits are these profits plus 3 into 8,000, because this 8,000 is also a profit. just they are put aside. This apart from this 8,000 per annum, these are the profits actually given, or these are the profits actually generated in the past. So that's why what are the total profits means, this 8,000 multiplied with 3 also you should need to include to calculate the average future maintainable profits. Sir, now goodwill calculation equal to average future maintainable profits into 3 years purchase. Here it is given that, sorry, 2 years purchase into 2 years purchase. You can calculate the average future maintainable profits like this: 1,20,000 plus 1,44,000 plus 1,68,000 plus 3 into 8, 24,000. This 3 into 8,000, 24,000 divided by 3 years, which is 1,52,000 I got, into 2, which is 2,04,000. Sorry, 3,04,000. So 3,04,000 is the goodwill of the firm. So this is derived from point number A and point number E. Put aside that. So goodwill of the firm is 3,04,000. Just put aside. Read these 3 points information. All assets and liabilities were taken over by the company. The loan creditor agreed to accept 7.5% redeemable preference shares in the settlement of the claim. All assets taken over by the company, all liabilities taken over by the company. Please, all of you think this problem, we are in the books of selling company. As like the procedure we adopted in case of amalgamation, the same procedure we are going to adopt here as well. Land and buildings and plant and machinery were to be valued at 4 lakhs and 96,000 respectively. The vendors were to be allotted equity shares. Who is the vendor here? Purchasing company. The vendors were allotted to equity shares means the purchasing company is allotted equity shares to the selling firm. You are required to show the realization account, partners capital account in the books of the firm, assuming that all transactions are duly completed. If it is amalgamation, they might ask the realization account and equity shareholders account. Just here they asked realization, partners capital account. 5-step approach, guys. First, dismantling of balance sheet. All the assets and liabilities which are taken over by the purchasing company should be closed and transferred to realization account at book values. Am I right? Partners capital accounts open separately. This reserve fund also you can transfer to partners capital. For remaining all assets and liabilities, simply transfer to realization. Step number 2, PC due. Calculate the PC. Sir, after reading the information given in the problem, we are unable to know how much amount payable to the partners directly. That's why method of PC is NAV. NAV means assets taken over at the rate of agreed value. All assets you should need to consider the agreed value, because land and buildings are different and plant and machinery also given a different value. Apart from that, don't forgot to add the goodwill, because goodwill is also one of the asset which was 3,04,000 but which was internally generated a goodwill, that's not included in the balance sheet. You can also consider the liabilities of sundry creditors and loan creditors and bank OD as well. Then you will get the NAV which is equal to the PC. Then step number 3, PC receipt. What PC you are getting here? Equity shares of the purchasing company. Distribute such PC among the partners. But before distributing that PC among the partners, find the realization account profit or loss. Such realization account profit or loss also you can just transfer to the partners' capitals. Am I right? Then you can go for the final distribution. Again, I am repeating. First dismantling, then PC due, then PC receipt, then after receiving the PC receipt, find the realization profit and all such stuff, then realization profit or loss transfer to partners capital, then final distribution among the partners. Now first calculate the PC by checking the answer given in the RTP. Now if you check the PC, they are followed the NAV method. They considered the goodwill which was 3,04,000. Land and building was separate value was given which was at 4 lakhs. Plant and machinery was given at 96,000. Remaining all assets are book values only. Liabilities also at book values only. PC are the NAV they got at 8,40,000. This is the working note. You can calculate separately. Now the first entry, assets and liabilities transferred to realization at their book value. These are the all assets transferred to realization at book value. All liabilities also transferred to realization at book value. Partners capital open separately. This is opening balance, and the reserves are there. The reserves also you can transfer to the partners capital. Dismantling of balance sheet over. Step number 2, PC due. Entry, purchasing company account to realization. In realization by purchasing company 8,40,000, we already calculated the PC in working note. Step number 3, PC receipt. PC receipt. Just wait. What the PC we received? Equity shares. That is the original. Here no need to give any posting because we opened only two accounts. What is that? One is realization and another one is partners capital. The entry was at the time of receipt of PC, equity shares of purchasing company accounted are to purchasing company, but we are not opening the purchasing company. That's why no need to give the posting because we not open the ledger. After receipt of PC, before distribution of PC among the partners, find the realization profit or loss. Here they find the realization profit. How much realization profit they got? 4,96,000. Such realization profit thus they distributed among the partners in the profit sharing ratio. Then which is the realization profit they distributed. Now in PC, how much they have? 8,40,000 in the form of equity shares. Now that 8,40,000 you can distribute among the partners. For partner A, which is 4,20,000, just distribute. For other partner, you got 4,20,000. You can also distribute that 4,20,000. Automatically, partners capital account close. All accounts closed. In the books of selling firms, all accounts closed if you follow the 5-step approach. Nothing is great. That is the reason why I clearly told you, sir, don't see amalgamation, selling company accounting treatment, and partnership firm conversion or sale problems. Do you understand? That's it, guys. This is for the day. So the remaining issues we can see through another video lecture. Until bye, have a nice day. Guys, in lecture 1, we completed entire accounting standards as well as partnership accounts, right? Now this is the time for rest of the chapters. So ESOP, buyback, equity shares with differential rights, amalgamation, then internal reconstruction, then NBFC and banking companies, yes, liquidation, then finally we'll end up with CFS, Consolidated Financial Statements. So let us see quickly problem by problem. Related to ESOP, Mehta Limited grants 1,500 stock options to its employees on 1/4/2019 at 50 rupees. The vesting period is 2.5 years. The maximum exercise period is 1 year. Market price on the date is 80. Fair value per option is 30. All the options were exercised on 30th September 2022. Give the necessary journal entries if the face value of equity share is 10 rupees per share. Now, if you observe here, date of grant is 1/4/2019. Date of vesting is 2.5 years, means exactly it is 30th September 2021. Am I right? This is 2.5 years. Now the maximum exercise period will be 1 year. That is last date of exercise is 30th September 2022. This is last date of exercise. And you know the value per option. What they required? Simple journal entries. Now, the total value of the options were 1,500 into 30. This is the total value of options, right? We need to amortize over the period of vesting period. That is 45,000. This 45,000 you need to be amortized over the vesting period, means divided by 2.5 years, which is equal to 18,000 per annum. 18,000 per annum. What are the journal entries? Sir, year number 1, that is as on 31st March 2020. Tell me guys, all of you. Employee compensation expense account at R2, ESOP outstanding 18K. Employee compensation expense transfer to P&L. Next, as on 31st March 2021. Again, employee compensation expense to ESOP outstanding 18K. Again transfer to P&L. The next financial year ending date was 31st March 2022. In between, date of vesting is over actually. But as on the last date of the financial year, just I'm passing the entry, employee compensation expense to ESOP outstanding. Now you should need to pass only for 6 months. For 1 year, 18,000, then for 6 months, which is 9,000. This also you need to transfer to P&L. Now, it was clearly given that all the options were exercised as on 30th September 2022. Now, as on 30th September 2022, what is the entry you need to pass? As on that date, bank account data, you will receive the amount. For 1500 options, face value is 10 rupees. And the exercise price is given at 50. So 1500 into 50 you will get, which is equal to 75,000. And the discount part, you can set off the ESOP outstanding account. How much balance will be there under ESOP outstanding total? 45,000. If you want, you can cross check. Here 18, here 18, 36 plus 9, 45. To equity share capital, 1500 into 10, which is 15,000. To securities premium, 1,05,000. Am I right? Tell me, guys. 75 plus 45, 120, 105 plus 15, 120. That's it. Such a simple problem. Next, come to problem number 4, buyback of securities. Umesh Limited resolves to buy back 4 lakhs of its fully paid equity shares of rupees 10 each at rupees 22 per share. This buyback is in compliance with the provisions of Companies Act and does not exceed 25% of the company's paid up capital in the financial year. For the purpose, it issue 1,11,000 preference shares of 10 each at par, the entire amount being payable with applications. The company uses 16 lakh of its balance in securities premium account apart from its adequate balance in general reserve to fulfill the legal requirements regarding the buyback. Give necessary journal entries to record the above transactions. Just they only asked the journal entries. One thing, guys, let me know the total amount of shares bought back, 4 lakhs. Am I right? Out of the 4 lakh shares bought back, the face value, the worth was 40 lakhs. Face value of the shares bought back, 40 lakhs. Out of this 40 lakhs, through fresh issue, 10 lakhs. They are clearly given that for this bought back, they are issuing preference shares. 1,11,000 preference shares means 1 lakh into 10 rupees, which is 10 lakhs. This is through fresh issue. Out of the existing resources bought back, 30 lakh. There is a provision that to the extent of the face value of the shares bought back out of the existing resources, we need to transfer to capital redemption reserve. That point you need to put in your mind. Now, first of all, for this fresh issue of equity shares, we need to pass the journal entry. What is the entry? Bank account data to preference share application and allotment account. That is 10 lakhs. Just a second, I'm opening that. I'm going to explain through RTP printed solution itself. Yeah. So bank account data to 11% is preference share application and allotment, then preference share application and allotment to preference share capital. This is for the purpose of fresh issue of shares. Next, concentrate, guys, all of you. Now we can start the buyback procedure. So buyback procedure entry, equity share capital account data to shares buyback account, then share bought back account data to bank account. Am I right? Each and every share we are going to bought back at 22 per share. That is 4 lakhs into 22, which leads to 88 lakhs. For that entries, let us have a look. Please all of you concentrate this. Equity share capital account data to equity share bought back and equity share bought back to bank. But here bought back is going to occur at premium. That's where the excess amount over the face value just you can transfer to the premium. So this is fourth entry and fifth entry are related to buyback. Now the premium on buyback, you need to make it set off, right? For this premium on buyback, you can set off with securities premium. For that, it was clearly given. The company uses 16 lakhs for its balance in securities premium account, apart from its adequate balance in general reserve. That means out of this premium on buyback, 48 lakhs, 16 lakhs, you can use the securities premium and the remaining you can utilize the general reserve. For example, if this point was not given, the entire amount we may set off with general reserve. But it was clearly given that you can utilize the securities premium 16 lakhs. That's why I debited the securities premium 16 lakhs, debited the remaining portion general reserve to premium on buyback, I cancelled. Now all of you please concentrate. Out of the face value of the equity shares bought back. 30 lakhs is from existing resource. That's why we need to make it transfer 30 lakhs to the CRR. General reserve accounted are to capital redemption reserve 30 lakhs. For that entry was given here. With this, buyback entry is over. Nothing is so no magic here, and nothing is crucial here. Just as a overall entries, just we can easily pass. Next, come here, equity shares with differential rights. Guys, this is the standard question regularly testing, and pocket marks. You can simply get it. Please, all of you concentrate. What is meant by equity shares with differential rights? Equity shares with differential right means rights. There is a variation in rights with respect to dividend. There is a variation in rights with respect to voting, or there is any other factor may also vary. That is nothing but equity shares with differential rights. Can preference shares be also issued with differential rights? No. This is a clear-cut provision given in the Companies Act 2013. Only equity shares with differential rights is possible. Preference shares with differential rights is not possible. Okay, fine. Let me cross verify the answer. The same was already discussed in our classroom. Once again, just I am confirming. So rights means dissimilar rights as to dividend, voting, or otherwise. Preference shares cannot issue with differential rights. It is only for equity shares. Next. Sir, this is the standard question. I don't want to speak anymore. So in a particular meeting, if both equity shares and preference shares are going to participate, then how you can calculate the voting rate? That is the question actually. For this, first you need to check the relative ratio in between equity and preference. If you check here, paid up equity share capital 80 lakhs, paid up preference share capital is 40 lakhs. Then the ratio is 2:1. That is 2/3 and 1/3 is the ratio. Now the entire 2/3 you can multiply with into 30 by 100, 30 by 100, 20 by 100, 20 by 100, and 1/3 you should need to multiply with 40 by 100, 30 by 100, 20 by 100, 10 by 100. Then you will know the individual voting power in that particular meeting. Okay, we already done number of times the same problem, which is a standard problem. That's why I don't want to discuss much on that. Next, coming to amalgamation of companies, guys, what he is asking in the question. First, let me check. Prepare balance sheet of Truth Limited after amalgamation. That means purchasing company balance sheet, just they are asking. Finally, they're asking in the question purchasing company balance sheet, guys. What is the given information? Two companies are there. One is Truth Limited, another one is Might Limited, which is a selling company, which is a purchasing company. So if I read the problem clearly, then you can easily identify. The balance sheet of Truth and Might as of 31st March 2021 is given below. Might Limited is to be amalgamated with Truth Limited from 1/4/2021. The amalgamation is to be carried out in the nature of purchase. He itself clearly given amalgamation in the nature of purchase. Okay. So, I mean, the 5 conditions which were given in amalgamation in the nature of merger were not satisfied. Any one of the condition was not satisfied here, or more than one condition also may not satisfied. Okay, share capital note number 1 given, equity shares and reserves and surplus, general reserve, P&L account, export profit reserve, which is a statutory reserve was given, but which is amalgamation in the nature of purchase. We need to maintain that statutory reserve by passing an adjustment entry, that is amalgamation adjustment account to export profit reserve account. Okay, fine. Next, non-current liabilities. Only debentures are there, which are 14% debentures in the books of selling company only exist. Next, coming to current liabilities, trade payable, other current assets are given. Then coming to assets, non-current assets, PPE is there, investments is there. Under current assets, if I go to note number 5, inventory, trade receivable, cash and cash equivalents were given. Am I right? Next, Truth Limited would issue 12% debentures to discharge the claim of the debenture holders of Might Limited, so as to maintain their present annual interest income. Okay. Now, purchasing company is going to issue certain number of debentures to the selling company. But how many number of debentures, sir? The debentures need to be issued by purchasing company to the selling company represent the same level of income. We can't understand, sir. Now, in the existing selling company, how much interest in generally enjoyed by such debenture holders? That is 1,50,000 into 14%. Into 14%. That is 21,000 interest is enjoying right now in the selling company. Now, purchasing company should need to issue such a number of debentures that The same level of income should also be enjoyed in the purchasing company after takeover. In purchasing company, what is the percentage of interest offered? 12%. That is into 12, or simply x into 100 into 12 is equal to 21,000. Or you can simply put x as amount of debentures. X into 12% equal to 21,000. Therefore, x is equal to 21,000 divided by 12%. So which are 1,75,000 worth of debentures need to issue. To discharge the existing debentures of the selling company, purchasing company is going to issue 1,75,000 worth of the debentures. Next, from here to here, the entire discussion is related to goodwill, guys. This problem is basically testing from goodwill point of view as well. Here, calculation of goodwill will plays the crucial role. Concentrate. Non-trade investment, which constitute 80% of their respective total investment, yielded income of 20% to Truth Limited and 15% to Myth Limited. First, go to the investments. All of you, go to the investment component. This is about investment. Here, 80% constitute non-trade investments. We are in the process of calculation of goodwill of Myth Limited. Concentrate, because we require the goodwill of selling company. Now, out of this 80%, one second. Yeah. Out of this 80% are non-trade investments, means 80,000 are non-trade investment. Am I right? Let me continue what here it given. So non-trade investment, which constitute 80% of their respective total investment, yielded income of 20% to Truth and 15% to Myth. If it is Myth, they yielded 15%. That is 80,000 into 15%. 12,000. Here it is 1,87,500 into 80% into 20%. Here it is yielded 30,000. So income on non-trade investments in purchasing company 30,000. Income on non-trade investments in selling company, it is given 12,000. Why it was given, sir? In calculation of goodwill, income on non-trade investment should not be considered actually. And non-trade investment entire component should be ignored at the time of calculation of goodwill. And one more thing, guys, if you check here, calculation of goodwill is based on capital employment method. That is normal, that is known as capital employment method. In case of capital employment method, goodwill is nothing but actual capital employed minus normal capital employed. Do you understand? Normal capital employed is nothing but average future maintainable profit divided by normal rate of return. If you know the normal rate of return, if you know the future maintainable profit, then you will get the normal capital employed. It should be compared with the actual capital employed. Then the difference is nothing but goodwill. Till now, we've seen the goodwill under super profits method, under the average profit method. But this is the first time I am come across in the capital employment method here. But in your foundation level or in partnership accounts and wherever you learn the concept of goodwill, you already aware the capital employment method. That method was testing from this problem. Okay. Once again, sir, why income on non-trade investment we need to discuss, sir? Here, under calculation of average future maintainable profit, you need to reduce income on non-trade investments. And under calculation of actual capital employed is nothing but assets minus outside liabilities. Under assets, you should not consider the non-trade investment. That is the level of significance had by the non-trade investments. Okay, this income is to be deducted from profits while computing average profits for the purpose of calculating goodwill. The same point was given. Profit before tax of both the companies during the last 3 years were as follows. Truth, Myth, both were given. Now, what you should need to do from here, one second. From here, you should need to reduce the income on non-trade investment. So in Truth Limited, income on non-trade investment, how much? 30,000. Or first, you can simply make it average. From there, you can reduce 30,000. Here you can simply make it average. You can reduce how much there? 12,000. Then you will get average future maintainable profit. And normal rate of return was given, which was 18%. Then if you divide one with each other, then you will get normal capital employed. If you can compare that with actual capital employed, you will get the goodwill. So first, let me complete the goodwill issue in the through printed solution. But before that, what the requirement? Purchase consideration is to be discharged by Truth Limited on the basis of intrinsic value per share. Here I need to calculate intrinsic value per share in selling company as well as intrinsic value per share in purchasing company. On that basis, PC should be disbursed. Okay. So to know the PC, all of you please concentrate. To know the purchase consideration, I should require the intrinsic value. Intrinsic value is nothing but NAV per share. To know the NAV, I required all the assets as well as all the liabilities, including the goodwill. Do you understand? That's why first let me start with the calculation of goodwill. One more time I'm telling you. To know the PC, I require the intrinsic value in both the companies. To require the intrinsic value is nothing but NAV per share. To know that, I required all the assets and liabilities values. To know all the assets and liabilities value, one of that component is goodwill. To know the goodwill component, I need to provide the workings. Now I am working on goodwill. Concentrate. Come down. Calculation of goodwill. First, I am working actual capital employed. Actual capital employed is nothing but other than non-trade investment, all the assets you should consider and all the liabilities you should consider. Now, if you check, all the assets in both the companies were here 5,12,500, here 3,65,000, out of which, sorry, this is not all the assets. Go up. Yeah, 2275, 11,45,000, out of which you need to reduce non-trade investment of 80% in both the cases. Now, the total assets, 80% is 1,50,000, 80% 80,000, they reduced. I already informed you. To know the actual capital employed, you should need to reduce the non-trade investment. The total amount of liabilities you can reduce. The total amount of liabilities for here 1,40,000, here 4,32,000. So here 1,40,000, here 3,32,000. Now you will get the actual capital employed. One component is ready. Now you should work out the normal capital employed. How to get the normal capital employed? Normal capital employed equal to average future maintainable profit divided by normal rate of return. You know the normal rate of return. First, you need to work out the average profits after tax. So 18 given, 19 given, sorry, 18, 19, 19, 20, 20, 21 given. Average you work out. Then simple average, you made it. From there, you can reduce the non-trading income of 30 and 12,000. 30,000 and 12,000 you should need to reduce. Then you will get the average profits. Now, average profits divided by normal rate of return, then you will get the normal capital employed. So this amount is the normal capital employed. This amount is the normal capital employed. Sorry, 1 second. Yeah. So this amount is the normal capital employed. This is the normal capital employed. If you compare the normal capital employed and with actual capital employed, the excess normal capital employed over the actual capital employed is nothing but goodwill here. So that's why in both the cases, the goodwill was 18,65,000. In case of Truth Limited, in case of Myth Limited, which was 4,67,000. 1 second, guys. Here I think so. I made the formula in the reverse angle. Normal capital employed minus actual capital employed is the goodwill. Just there is I assigned the wrong signs. Just I made it corrected now. Hope you got the clarity right. Now you know the goodwill, right? Now you can work out the intrinsic value per share. How to calculate the intrinsic value per share? Intrinsic value is nothing but NAV per share. For that calculation, here I made the another working note. Truth Limited, Myth Limited. First take the component of goodwill. You know the other assets total. Just now we work out na other assets how much? 22,75,000. Here 11,45,000. This is not the goodwill calculation. You can consider all the assets, all the liabilities. We are calculating the NAV of both the companies first. So all the assets we added, all the known liabilities we reduced. Then net assets for Truth 40 lakhs, net assets for Myth 12,55,000. Division with the existing number of equity shares. Then you will get intrinsic value per share in purchasing company 40, intrinsic value per share in the selling company 31.375. Then amount of PC how much, sir? 31.375 into 40,000 shares is the amount of PC. 31.375 into 40,000, 12,55,000 is the amount of PC. Do you understand, all of you? Sir, if you know the amount of PC, your most of the problem is over. Now, we are not in the books of selling company. We are in the books of purchasing company. That too, here I'm not providing any journal entries. We can only work out one thing. Sir, is there any capital reserve or goodwill will come, sir, while comparing PC with NAV? Here PC is also under NAV method because intrinsic value is equal to the NAV. There is no goodwill or no further capital reserve arised apart from this goodwill. Apart from this goodwill, there is no other goodwill or capital reserve is arised in the books of purchasing company. Okay. Now all of you go to the balance sheet. Consider all of you one by one. We are in the books of Myth Limited. Sir, existing share capital, how much, sir? Existing share capital. In Truth Limited, the existing share capital was 10 lakhs. In the form of PC, how many number of shares you issued? Just now I worked out, na? In the form of PC, how many number of shares we issued? Where it is? Just a moment, please. Yeah, here we worked out. So in the form of PC, we are issuing 31,375 shares. So 31,375 shares into 10 is the face value, which was 3,13,750 plus the existing amount of share capital 10. That's a total 13,13,750. 13,13,750 is the share capital. Now, securities premium itself. Securities premium. All of you, please concentrate. Now, out of the 40,000 shares, sorry, how many number of shares? Not 40,000. Just a moment, please. Don't be confused. Out of the 31,375 shares, each and every share is issued at 40. That's why 30 rupees per share is the securities premium into 30. Into 30. That is approximately I got 9 lakh. 1 second. 9,41,250 is the securities premium here. That is one thing. And one more, we issued the debentures, right? Debentures are issued at face value only, right? Oh, yes. So only the securities premium is only this amount, 9,41,250. Let me check under the notes to accounts. Yeah, which is 9,41,250. Concentrate, not it over. Here general reserve is there for 5,05,000. Yes, general reserve is there for 5,05,000. P&L is 4,45. P&L is 4,45. One more thing, the export profit reserve of Truth Limited should need to consider. I should also need to consider for Myth Limited as well by passing the entry amalgamation adjustment accounted up to export profit reserve. That's why amalgamation adjustment I shown 25,000 negative and the export profit reserve I surely combine for both. Do you understand? So 1,85,000 plus 25, which leads to 2,10,000. This is the total of reserves and surplus. Like this, you should need to think in the examination without providing any working notes and all other stuff. So remaining all are simple line by line addition, guys. Please concentrate, all of you. On behalf of this 14% debentures, we are issuing the 12% debentures. That value was 1,75,000. We already worked out. So here you can work out 1,75,000. Trade payable line by line addition. Trade payable line by line addition. Other current liabilities line by line addition. PPE is line by line addition. Investments is also line by line addition. Except this share capital and reserves and surplus and this non-current liabilities figures, remaining all are simple line by line additions. That's it, guys. That is all about balance sheet in the books of purchasing company, that is Truth Limited. Hope you understand. I'm discussing the entire problem in very crispy manner. I'm so sorry. The time is not allowing to me to discuss in detailed manner, and that too in this time. If I explain in this manner, you should need to able to grab the content as well. Then only you are in the good phase. Next, come to the next problem, which related to internal reconstruction of the company. I think so. They require the only journal entries. Let me check. You are required to pass the journal entries. If you know the journal entries, you can easily prepare the capital reduction account. The other stuff, prepare notes to accounts on share capital and PP immediately after the implementation of internal reconstruction. Let me check one by one entry for the internal reconstruction impact. First, Planet Limited has decided to reconstruct the company since it has accumulated huge losses, right? Which is a loss-making company. Following is the balance sheet of the company as on 31st March 2022. Share capital given, reserves and surplus given. Under this share capital, equity is there, preference is there. Okay, face value 10 rupees for equity and face value 100 is for preference. Reserves and surplus, P&L account debit balance exists. Long-term borrowing, 6% debentures and director's loan, both are long-term borrowings for given. Then coming to current liabilities, trade payables and other liabilities for given. Under trade payables for goods, other liabilities, interest accrued and due on 6% debentures for given. This is all about liabilities. Under assets, PPE, current investments, inventory, trade receivable, cash and cash equivalents. All the notes were clearly given, guys. Let me read the further information. Board of directors of the company decided upon the following scheme of reconstruction with the consent of respective shareholders. Preference shares to be written down to 75 each and equity shares to 2 rupees each. What is the entry, guys? Preference share capital account at R. How much? 100 rupees face value, total amount. 2. Reconstruction account or capital reduction account. 75 multiplied with 6 lakhs. 2 preference share capital. 6 lakhs multiplied with 25. In the same manner, equity share capital account at R, the total face value. 2 capital reduction. How many number of equity shares? 150 lakh into 8. 2 equity share capital, 150 lakh into 2 rupees. Hope you are following the things. Preference share dividend in arrears for 3 years to be waived by 2/3 and for balance 1/3 we are allotting. Sir, which is known as unrecorded liability. The unrecorded liability is waive of no entry. For this, no entry. And for the remaining 1/3, you are going to issue the equity shares. That's why the entry was reconstruction account at R2, equity share capital account. Debenture holders agreed to take one freehold property at its book value of 450 lakh in part payment of their holding. Debenture holders account at R, or debentures account at R to freehold property 450. Next, interest accrued and due on debentures to be paid in cash. If you observe here, under the liabilities, other liabilities, interest accrued and due on 6% debentures is there, na? That is interest accrued account at R to bank account 36 lakhs. Next, remaining freehold property to be valued at 550 lakhs. What is the total amount of the freehold property? The total amount of freehold property was 825. Out of 825, you already given to the extent of 450 to the debenture holders. So remaining will be 375. Thus 375 was now upward revalued at 550 lakhs. That's where the entry was freehold property accounted to reconstruction account for the difference amount, which was 175. All investments sold out for 425 lakhs. Bank account at R 425. Two investments 300. Two reconstruction. The difference, which was 125. 70% of directors loan to be waived and other balance equity shares of 2 rupees each to be allotted. Directors loan accounted are to reconstruction to equity share capital. 40% of trade receivables and 80% are inventories to be written off. Reconstruction to trade receivable to inventories as per their percentage, just you can work out the amounts. Companies contractual commitments amounting to 900 lakhs have been settled by paying a penalty of 72 lakhs. Reconstruction to bank 72 lakhs. Now after recording all such general entries, you can find out the reconstruction account balance. Now with the balance of reconstruction, you can make it set off the P&L account debit balance, which was 783. Still, if there is any balance under reconstruction account, you can make it transfer to capital reserve account. That's it, guys. That is the end of problem number 7. I not to open the printed solution, just I made it work out through our problem itself. Next, coming to liquidation of company, guys, what they required. Company went into liquidation, that prepare liquidator statement of account, which is a simple R&P account, right? Liquidator final statement account is a simple R&P account. Now land and building is there, other fixed assets, inventory, trade receivable, P&L account. Credit balances, share capital, preference shares are there, equity shares are there, bank loan 8% debentures, interest outstanding on debentures, and trade payable. Liquidation expenses 3,000, liquidator remuneration 10,000. Bank loan was secured by pledge of a stock. So this inventory is assets specifically pledged. Remaining all are ANSP. Debenture and interest thereon are secured by a floating charge on all assets. Fixed assets were realized at book values and current assets are at the 80% of the book value. Now you can start fixed assets 100%, right? Current assets at the rate of 80%. You can start the liquidator final account. Start with land and building, full value. Then other fixed assets also full value. Then inventory 80% as value. Work out the 80% as value. From there you can reduce bank loan. From there you can reduce the bank loan, which was 4 lakhs. Sir, inventory, if you realize that 80% is 5,25,000 into 80%, which was 4,20,000. So the surplus amount was 20,000. You can carry forward to the last column. So remaining all are I'm not working. Just you can proceed in the as usual manner. Trade receivables also you will get the 80% only. That is the realization from assets. Now you can start making payment first for liquidation expenses, then liquidator remuneration. After that, guys, there is no preferential creditors. That's why you can go with the secured creditors with floating charge, which is nothing but 8% debentures. And interest also you can work out because which is also a floating charge. Then after that, if the cash balance is available, you can make payment to the trade payables. Then still if cash balance is there, then you can go for preference shareholders, finally equity shareholders. Let me cross verify with the answer. So check here for liquidator final statement, guys. 1 second. Yeah. So assets realized, land and building 100%, other fixed assets 100%, inventory 80%, out of it bank loan 20,000 is a surplus, trade receivable 80%. Liquidation expenses, liquidator remuneration, debenture holders and interest, trade payables. Then the only cash balance is 4,000 that was distributed among the preference shareholders. Nothing is great here. That's it. Okay. Next, come down. Come to the NBFC. What they are asking? Net owned fund. What is the meaning of net owned fund? Before that, first you need to check the net owned fund definition. Net owned fund is nothing but owned fund minus excess of investments in subsidiaries or other NBFC over 10% of owned fund. So to crack this, first you should need to know the owned fund. What is the meaning of owned fund? Equity share capital plus convertible preference share capital and free reserve, securities premium, capital reserve realized in the cash. Revaluation reserve should not be considered. P&L should be considered minus intangible assets minus deferred revenue expenditure. From the given information, shareholders funds, paid up capital you should consider. General ledger you should consider. Am I right, guys? There are no other liability. You should not consider any other liability. Assets, any intangible asset is there, you should need to reduce. There is no intangible asset, investment, cash and bank. So no need to consider. So these two are only the net owned fund. I think so. Owned fund. I'm only talking about owned fund right now. So that's why owned fund is 800. That's it. They only included which was 800. Now net owned fund is nothing but owned fund minus investment in excess of 10% of the owned fund. Now investments 250 plus 400, 650. Investments in excess of 10% of owned fund. 10% of owned fund is 80. So this is nothing but net owned fund. So you can check here. This equation is 570. 800 minus 570, 230. Net owned fund is 230. That's it. Is it okay, guys? Guys, this is regularly testing from the NBFC. Please, all of you may concentrate. Next, come down. Banking companies, guys. Related to banking companies, just they're asking to prepare the P&L account. So nothing is great. P&L account having exactly 4 schedules. One is income earned. Another one is other income. Next one is interest expenses, other operating expenses. One more thing is also there, but schedule number will not exist, which was provisions and contingencies. Am I right? So out of this, just make it split into the interest, discounts and all such things under interest earned and other income. What are the other income? Commissions and all other income you can put there. Interest expenses you can put here, that is interest on deposits. Other operating expenses, audit expenses, salaries, okay, printing and stationery, electricity expenses, all such stuff you can put here. provisions, that is based on standard asset, substandard asset, loss assets. You can work out the provisions here just to make it present in a proper format. Now the same thing was made here. Interest under schedule 13, other income schedule 14, interest expended, operating expenses, provisions and contingencies. Then the total income minus total expenses, you will get net profit for the year. Add accumulated profits, then you will get the total profits. Out of the total profits, from the current year profits, 25% you should need to make it transfer to the statutory reserve as per the Banking Regulation Act. Then the remaining you can carry forward to the balance sheet. Nothing is great here, guys. Okay, fine. So that is the reason why I'm not taking each and every component here. The similar problem we already done in the classroom. If you want, you can check the classroom problem for the reference. Okay, so that is all about banking companies problem. Sorry, here. This is all about banking companies problem. Now this is the time for consolidated financial statements problem. Please concentrate, guys. Yeah, guys, which is the final problem for the RTP. First, let me check what is the requirement. Prepare the consolidated balance sheet as at 31st March 2022. You should need to apply the 4C approach. No doubt about it. Am I right? So one C is for cutoff data, another C for classification, and another C is for chart A, minority interest calculation, chart B, cost of control, and chart C if mutual owings is there. Am I right? Then chart D, consolidated P&L or consolidated reserves and surplus simply. Then you can go for final C, which was consolidated balance sheet. Maybe in their own presentation, they might given in the printed solution, but we are in generally following the same structure for presentation of CBS. These all you can make it present as a notes to accounts or working notes, whatever the case may be. This is the main theme actually. Remaining all you can make it present under working notes, not an issue. Okay. Now, first let me check the information. On 31st March 2022, H Limited and S Limited are the two given companies, and rupees are in thousands exist. Equity share capital authorized was given. Not required, just sake of information only. Issued and subscribed in equity shares. So for H Limited, which were 4 lakhs, and S Limited, which were 40 lakhs and 24 lakhs. General ledger given. P&L account credit balance is there. Trade payable, provision for taxation, other provisions, plant and machinery, furniture and fittings. Investment in equity shares of S Limited. So which were given at total 15 lakhs. 15 lakhs worth of equity shares are held by H Limited in S Limited. Inventory given, trade receivables, cash and bank, sundry advances. Following additional information is available. H Limited purchased 90,000 equity shares in S Limited as on 1st April 2021. On the date, the following balances stood in the books of S Limited. If you observe, right now the number of equity shares were different, but initially the number of shares held by holding company and subsidiary are different. Because here it is clearly given that 90,000 equity shares. But if you check here, if the each equity share face value is 10 rupees means this is 150,000 means that is right now 150,000 equity shares held by holding in subsidiary. I mean to say there may be in further after original acquisition, maybe certain bonus shares are issued by the subsidiary, like that may happen. That is, or somewhere it might be given. Yeah, in point number C, bonus shares information is given. So before issue of bonus shares, 90,000. After issue of bonus shares, it will reach to 150,000. Is it okay? Fine. Next. So as on the date of acquisition, general reserve is given at 1500,000 and profit and loss account is given at 633,000. This is for the purpose of calculation of capital profits. It is useful. Coming to point number B, on 14th July 2021, S Limited declared a dividend of 20% out of pre-acquisition profits. H Limited credited the dividend received to its profit and loss account. The original entry was bank to investments, but they wrongly made the entry as bank to P&L. Now what should I need to do? Now you should need to pass the rectification entry. The rectification entry was P&L account data to investments. This is the thing. This is the adjustment you need to make. You need to reduce the profits. You need to reduce the investments as well. Investments you can reduce from chart B from while calculating the cost of control. The P&L of the holding you can reduce under chart D at the time of representation of consolidated reserves and surplus. Am I right? Next. On 1st November 2021, S Limited issued 3 fully paid equity shares of 10 rupees each for every 5 shares held as bonus shares out of pre-acquisition general reserve. Bonus shares are also issued from capital profits. That point he is mentioning here. For every 5 shares, they are issuing 3 bonus shares. That is, after issue of bonus shares, number of shares will become 8. Tell me, guys. Now, before issue of bonus shares, they have 90,000. For every 5 shares, they are going to issue 3 shares, means 90 into 3 by 5. 90 into 3 by 5. So, number of bonus shares received by a holding company. Just a second. Yes, the number of bonus shares are 54,000. After issue of bonus shares, 90 plus 54 means it will be 1,44,000 shares. So what about this 15 lakhs? I wrongly calculated earlier. I divided with the face value. That's not correct, which is cost of investment. I'm so sorry. This is cost of 15 lakhs is the cost of investment. This is 1,44,000 equity shares are after issue of bonus shares. Now, out of this 1,44,000 shares, how many number of shares? How many number of shares acquired by the, just a second, I'm so sorry. Please behold, this is the 90,000 shares held by holding company and subsidiary. After issue of bonus shares, number of shares held by holding company and subsidiary were 1,44,000. That's correct. Now, in calculation of percentage of holding interest and percentage of minority interest, how we should need to work out? Please concentrate, all of you. The total number of equity shares in subsidiary were 24 lakhs. That is 24 lakhs divided by 10 means 2,40,000. Out of such 2,40,000, I acquired 1,44,000 equity shares. That is 1,44,000 divided by 2,40,000. That is 60%. Out of percentage of holding interest is nothing but out of 2.4 lakhs, number of equity share held by holding company in subsidiary were 1,44,000. Now, which is 60%, which is 40%. Is it okay? Fine. This is useful for that purpose. Okay, come to point number D. On 31st March 2021, the inventory of S Limited included goods purchased for 50,000 from H Limited, which had made a profit of 25% on the cost, which is a downstream transaction. Downstream means goods are sold by holding company to subsidiary. Then these goods are sold at greater than the cost of holding, which made a profit of 25% on the cost price. This is 25% on the cost means on selling price, which was 1/5. 1/5. I mean, I can put like this 20% profit on selling price. Now, on the subsidiary as on the date of balance sheet, we should need to create a stock reserve by passing the entry P&L to stock reserve account. Stock reserve should need to be reduced from the consolidated stock amount, and this P&L is related to holding company P&L. This P&L is related to holding company P&L. In consolidated reserves and surplus, you can reduce that amount. So 50,000 into 20% means, which was 10,000. Sir, what is the adjustment? The adjustment is in chart C. In chart C, I need to reduce stock reserve from the combined stock amount. And in chart D, while presenting the P&L, I need to reduce 10,000 from the P&L. Do you understand? Uh, this is about point number B adjustment, and this is about point number D adjustment. Point number B adjusted in chart D and chart B. Point number D adjusted in chart C and chart D. That is the beauty. Okay. Next, details of trade payables and trade receivables are given. Bills payable, sundry creditors, debtors, bills receivable. These are simple line by line addition. No worries. Prepare a consolidated balance sheet as of 31st March 2022. Now, here, first my part is, please concentrate, guys. First, our part is, sir, what we should need to do, sir, before preparation of balance sheet. We can start with first see cutoff data. Just now I already mentioned the cutoff data. Percentage of holding interest, percentage of minority interest. 60-40. Date of acquisition and date of consolidation. So date of acquisition was given at 31st March 2021, or you can call it as 1st April 2021. Date of consolidation is 31st March 2022. Cutoff data over. Now you can go for classification. Am I right? Under classification, what you should need to classify? Should need to classify the entire reserves and surplus of subsidiary into capital profits and revenue profit. If you check subsidiary having general reserve of 690 and a P&L account balance of 810, concentrate general reserve, and it also have the P&L. P&L is 810, general reserve is at 690. Now here my question is, opening it is clearly given that general reserve is at 1500,000, but suddenly it came for 690. How it is possible? Opening it is at 1500, right? Now it is clearly given that bonus shares are issued from pre-acquisition general reserve. How many number of bonus shares they might issued? How many number of bonus shares they might issued? Please concentrate. For 60%, 54,000 bonus shares issued, right? Then for 100%, which are how much? 100 into 54 divided by 60%. So which are 90,000 total bonus shares issued by subsidiary, out of which 54,000 held by holding. Please concentrate. So this is 15,000, right? Opening less bonus shares. So bonus shares total number of bonus shares for 90,000 into 100. Right only, correct? Just a moment. Guys, face value is not 100, right? 10. Just a moment, sorry. So here you can change the face value as 10 rupees. So which was 900,000. Now 1500 minus 900 means which leads to 600, but still it is there 690. That means in the current year, there may be a transfer from P&L. Transfer from P&L, the balance, which was 90. Now the picture clarity, please concentrate all of you. Out of this 690, 600 is capital profits. And out of this 690, 90 is revenue profits. Come to P&L, please concentrate all of you. Come to P&L, 810. We know opening balance, how much is available. This analysis is pretty much important, guys. In opening, P&L is 633,000, 633. But how it suddenly become 810? In opening, 633. And one more thing, it is clearly given that on 14th July, S Limited declared a dividend of 20% out of pre-acquisition profits. If S Limited declared a dividend means, so before issue of bonus shares, number of shares were 150,000 before issue of bonus shares, because after issue of bonus shares 240. So bonus shares were 90. So before issue of bonus shares, number of shares were 150,000. On that, 20% dividend means 150 into 20% dividend. Okay, that is 300, right? This 333 should be required. Then how it become 810? So which is current year? Profits. Difference is how much? 810 minus 333, which was 477. That's it, guys. This is the current year profits. Now, out of this 810, 333 is capital profit. This 477 is revenue profits. Now, the total of the capital profits, were 933 and the total of the revenue profits were 567. Am I right? If you can able to demonstrate this classification, and half of the problem is over, because the next one is coming under chart A, calculation of minority interest, where you can start with share capital, capital profits, and revenue profits. Here 100%, here holding interest, here minority interest. Now, share capital of the subsidiary, how much? 2400. Now the total capital profits, how much you got? 933. 933 is the capital profits. I'm not differentiating, just I'm mentioning the total. Revenue profits, how much? 567. Okay, so holding 60, minority 40. You can divide the total minority, carry forward to balance sheet, this amount. Now out of the holding, these two components of 60% go to chart B. This portion go to chart D. I mean, this is not the total, only 60%. Just a second. 2400 plus 933 into 60%, which is 1999.8. Okay, here this is 567 into 60%, 340.2. This will go to chart B in calculation of cost of control. This will go to chart D in knowing the consolidated reserves and surplus. Then after chart A, you can go for chart B for calculation of cost of control. Start with cost of investments. It is there here itself. The cost of investments was given 1500. You should compare with, 1 second. First, you can start with share in net worth in the subsidiary. That is, just now we got 1999.8. From here, you can compare the cost of investments. Now, they unnecessarily credited to P&L, right? But we need to reduce from cost of investment, right? What is that? The declared dividend. No, that dividend you can reduce here. Less dividend wrongly credited to P&L. Now, you know the cost of control here. I'm not presenting the figures. Then you know the cost of control. After completion of chart B, you can present the chart C. Write the stock of holding, stock of holding, and the stock of subsidiary. You can put the totals. From here, you can reduce the stock reserve. Then you will get the stock need to be represented in the balance sheet. Are you following, guys? Then come to chart D. Come to chart D. Sir, in chart D, you can start with general reserve and P&L, which are there in holding company directly first. First holding company. Existing general ledger how much? P&L how much? In holding, general ledger 928, P&L 1305. So you can start those figures first. From here, wrongly created to P&L, na? Dividend wrongly created to P&L. That dividend you can reduce. And one more thing, guys, the stock reserve amount you can reduce. Stock reserve, P&L to stock reserve, na? That amount 10,000 also you can reduce. Okay. Then you can add revenue profits of holding company, which are 340.2. Out of this general ledger how much, P&L how much, you can segregate. That revenue profits also you can add. This is the consolidated reserves and surplus amount. So the entire information was given here, except this, any item is there, simple line by line addition. That is the end of consolidated balance sheet. Sir, in any rough sketch or in the any rough manner, just I make it presented the consolidated balance sheet. The in detail discussion I didn't give anywhere. So please, you can follow the printed solution itself if anything is not understandable. Okay, that's it, guys. This is the end of November 2022 Advanced Accounting RTP. All the best. Hope you will qualify the CA Inter examinations with flying colors. Bye bye, guys. Signing off.